Welcome back to the live studio. I am delighted to be joined by the authors behind two prize-winning papers for the PRI Outstanding Research Award. So welcome to the studio, Atreya Day, PhD candidate from the University of Edinburgh, and Tom Gosling, Executive Fellow from the London Business School. The PRI Outstanding Research Award recognising cutting-edge research. Atreya and Tom's papers were selected out of 200 submissions from the Academic Network Conference's call for papers. So this is a huge accomplishment. Congratulations to both of you. Just a reminder, you can submit questions to our guests using Slido. You can select Slido on the right-hand side of your screen and choose Live Studio. And I'll be posing your questions to them in a little bit. So let me start with you, Tom. You won the prize for the best paper alongside your co-authors, Alex Edmonds, also from London Business School, and Dirk Jentner from LSE. And this was for your paper, Sustainable Investing, Evidence from the Field. And this was a study about how portfolio managers take environmental and social performance of companies into account in investment decision-making. So can you share a bit about what you found?
Yeah, sure. And thanks very much for the invite to talk about the paper. And we're very grateful to the PRI for the award. So we did a survey of portfolio managers. So importantly, it's portfolio managers, not ESG or sustainability professionals, managing funds mainly marketed in North America and Europe. And we asked them about how they take environmental and social factors into account. And I mean, there's so much sort of intriguing and fascinating stuff that came out of this, as you can imagine. But let me just pick up on one strand, which is that overwhelmingly, portfolio managers, whether of traditional funds that don't have any mandate constraints or funds that are marketed as sustainable, regardless of the type of fund, portfolio managers are really in the business of maximizing financial returns. So even when we looked at sustainable portfolio managers and asked them how much return would you give up to improve a company's environmental or social performance, only 31% would give up even 1 basis point of return, and only 15% 10 basis points of return. So these portfolio managers are really not in the business of trading off financial returns against environmental or social performance. So this then raises the question, well, how are you ever going to get environmental or social impact of any form out of an investment fund? And what we find is that there are really two main channels for that. So one is constraints. So the fund will have a mandate that might constrain what it does in various ways, which means that the portfolio manager is then maximizing returns subject to those constraints. And so those constraints, if they're carefully constructed, could create some sort of environmental or social outcomes. Now, what we see is that they're pretty blunt, these constraints. So commonly they relate to the exclusion of certain stocks. That is not only a slightly blunt instrument, but actually can also have perverse consequences, because we found that nearly a third of sustainable portfolio managers found that they were actually prevented by their mandates from investing in and improving the ES performance of poor environmental or social performance. So there can be unintended consequences of some of these mandates. So the other channel for how you could get sort of ES performance out of this fund management process is through the fund manager beliefs. So if a fund manager believes that environmental or social performance is a driver of returns, then they're likely to factor that into their stock selection process, but they're also more likely to engage with companies to try and persuade them to improve their environmental or social performance. And indeed, we find that relationship between beliefs and those activities. But what's really fascinating is that that belief in environmental and social performance as a performance driver does not divide cleanly between sustainable and traditional fund managers. So we have 25% of sustainable portfolio managers who don't believe in environmental or social performance as a value driver, but actually nearly half of traditional fund managers who do. So a retail investor or an asset owner he's trying to identify a fund manager to delegate their fund management to, if they're concerned about environmental and social factors, really need to look under the bonnet of the fund, not just in terms of the very specific items that appear in the fund mandate, but also try and get a handle on what are the beliefs of the fund manager, because that actually really affects, in practice, what's going to go on in the investment process and how environmental or social performance is going to figure.
Fantastic. Do you have any thoughts on how we could shift those beliefs when they need to be, changed?
I'm not sure you can shift the beliefs because they're inherent to the portfolio manager. And I think, talking to people about the paper here, practitioners, they've identified that. I was talking to someone last night. He said, look, we've got, a couple of hundred kind of portfolio managers in our firm. They all have different beliefs. So we have these firm-wide policies, which interestingly act a little bit like mandates and place constraints on these portfolio managers. So it's not just the mandate that's providing constraints, it's these firm-wide policies that are providing constraints. But ultimately, you have heterogeneous beliefs across the portfolio manager population, and there's not a lot you can do about that. But I think what an asset owner or a retail fund investor can do is, at least whether it's through an interview process, if you're an asset owner, or by really looking at kind of the fund documentation and prospectus, try and just garner some kind of insight into what the portfolio manager really believes, because I think it really counts. And what I found really fascinating is that we've got this population of sustainable fund managers who don't really believe in it, right, as well, and which is also kind of counterintuitive. They're just sort of going along with it because the mandate says. So it's a very fascinating area.
It really is, and these findings are so interesting. Can I ask, why did you decide to use a survey approach?
Yeah, because I think really, in many ways, archival data, you might say, well, that's the gold standard of academic research. We get the facts and we analyze the facts. The problem with data is that you only see the outcome of the process, not the workings of the process itself. So we really wanted to understand, what is it that, so you might observe that funds hold certain weightings of more or less kind of sustainable stocks, but you don't know why they do that. You don't know whether that's because of a financial motivation, an impact motivation, or just because somebody's been told to do it by their fund mandate. So the survey enables us to really dig into what some of those kind of motivations and processes are. But then I think what surveys do really well is open up new research questions that smart empirical researchers can come along and try and identify a kind of a data-based research approach that can either prove or disprove a question that is raised by the survey.
Brilliant. So can I just ask, are there any key takeaways for investment practitioners from your research?
I think the key takeaway is that, financial incentives really matter, right? And portfolio managers have incentives, strong incentives to maximize financial returns. And I think, as we sit in this conference, there's a lot of talk about how can we have more and better environmental or social impact. And sometimes I think we hope for too much from just sort of exhorting people to do more or hoping that people will do more. Actually setting the right financial incentives really, really counts. And we always need to look at where those incentives are pointing, because that's generally going to be a very good predictor of where the behavior is going to follow.
Fantastic. Well, let's go to you now, Atreya. You won Best Student Paper for Inattention to the Coming Storm, Rising Seas and Sovereign Credit Risk, so a different topic. And the study investigates whether the sovereign credit market incorporates coastal flooding and risks of sea level rises. What were the key findings from your paper?
So this is Tom made a great point about how can researchers think about either doing more of a survey-based approach or more of a detective kind of looking at how prices change. And so this paper is much more looking at the second aspect. How are prices reacting towards coastal flooding risk and sea level rise? And so I chose to do these two types of risks because they're so damaging. Coastal flooding disasters are extremely damaging towards low-lying regions, and sea level rise will only exacerbate the issue. There's some studies that have come out recently thinking about how just a few millimeters of sea level rise will exponentially increase the frequency and damages of these types of coastal disasters when they do occur. So these two risks are quite interrelated, right? So what I decided to do first was to look at the sovereign credit market to see and understand whether these two types of risks are priced. So the coastal flooding disasters or coastal flooding risk is much easier to understand and to use geospatial data to really understand which sovereigns and which countries are most vulnerable. So that's the first step I approached. I used an attention index, essentially a news proxy for investors to incorporate information about this risk. And I found that a 1 standard deviation, essentially in this attention or from investors, increases credit risk of these vulnerable countries by about 73 basis points. And so once I uncovered this relationship between coastal flooding risk, I then could look at the more complicated risk of looking at how sea level rise and whether this is actually being priced in the market, right? And so what I find is that as information becomes more salient, the market isn't pricing sea level rise risk. So, and the main issue is that this information is quite complicated to incorporate. Lots of climate scientists have developed forecasts. And so what I find is that this type of risk is incorporated over a much longer horizon, so about a quarter or so. And so it takes time for investors to incorporate this information. And what's really interesting is that back in the 2000s and 2010s, climate scientists had this, or there was this basic idea that coastal regions would essentially explode in population growth, right? While the inland regions would stay fairly stable. And this hasn't really panned out, actually. So as you may know, population growth has somewhat subsided in most regions. And actually what we're seeing is that there's much more growth inland. So countries are becoming less vulnerable. So these projections that were made back in 2000, 2010s were actually incorrect. So there's this potential mispricing that's occurring because investors are using this older information to incorporate the risk. So those are the main points from the paper.
Fantastic. But before we come on to kind of the practical application,
Sure.
Can we just talk a bit about the methodology? Was there anything unique in your methodology that you'd like to highlight?
Right. So the main issue with trying to see whether markets are pricing these risks is that sea level rise and coastal flooding are very infrequent, right? And sea level rise is very slow to occur. So what I instead use is to use the news and attention index to proxy for when this types of risks are more salient to the market. So that's one way that's unique to the paper. And the second thing is to use geospatial data developed by climate scientists to really understand what were the risks that were developed back in about 2010 and between 2010 and 2020, and how these risks were actually incorporated in the market, right? So they used a lot of geospatial data to see what percentage of the population in each of these countries were vulnerable or not. So those are the two unique aspects of the paper that I produce.
Fantastic. It's so fascinating what you've done. Looking forward, how does your research contribute to RI practice, and what is the impact you'd like to see from your research?
Sure. So so now that I've been able to uncover this about 73 basis point, this is what the market is essentially ascribing a premium towards coastal flooding and sea level rise, right? So between 73 basis points and about 140. And so using these point estimates, we can back out essentially a discount rate, right? Discount rates are super important in the climate literature because then we can see how our investments now today, how are they worth to defend against these types of disasters, and how can countries think about these investments in the long run. So a lower discount rate means that we're valuing the damages at a greater rate for the future, right? So when I back out the discount rate, it goes to about 1% to about between 1 to 4%, which is actually really good news, right? This is good news because that means that RI investors can deploy capital in order to potentially shift sovereigns to build protection in a much cheaper way against these types of disasters, right? So they can deploy this capital, they can really use it in a way that protects against sea level rise and coastal flooding risk in a cheap way. And that can protect thousands of people, economies all over the world. So it's a really one practical use of the estimates that I produce.
Fantastic. It's great to hear of the kind of practical applications of this really interesting research that you've done. Tom, I want to come back to you. A key goal of the PRI research programme, the Academic Network and the Academic Network Conference is to bridge this gap between practitioners and academics. What is your view on effective collaboration? How do we encourage that between academics and practitioners?
Yeah, I mean, it's a really great question. It's a big part of what I try to do now in my role at LBS. And first of all, I just like to say, I think it's just so important, right? Because investors are having so much stuff thrown at them at the moment, right? So they're being told that they're ignoring all of these critical risks, and they're being told that they're not doing enough to solve the world's problems. And so, there is a risk that they get into quite a reactive mode. And I think what academics can do is, in a really dispassionate way, kind of look at these questions around what are the risks, what's priced, what's not priced, what's going to work in terms of real world impacts of different investment techniques, and can have the time and space and in a way kind of, distance from the heat of battle, if you like, to shine a light on some of these questions. So I think it's a really potentially fruitful collaboration. I think getting together at conferences like this is really useful. I mean, my view though is that what we really need is ongoing kind of dialogue and relationships between practitioners and researchers, not just coming together and then going apart once a year. So it's good to see the PRI building the academic network on more of an ongoing basis, trying to create those touch points more regularly. I also think that there's maybe something for academics to do, to take the time sometimes to help communicate to practitioners what's happening overall in a body of research, right? We all tend to get obsessed with our own papers because they're such labours of love and they take so much of our time and energy to produce. But actually for practitioners, any one of our papers isn't that useful actually. It's in a kind of tiny setting. What practitioners really need to understand is what's generally agreed, where is the dispute, and actually how can I interpret that and make a judgment on that for my day-to-day work. And I think we probably need as academics to try to do a bit more of that.
Fantastic. Atreya, do you want to add anything to that?
Sure. So I'm in a quite privileged position where my PhD is actually funded by an investor, Bailey Gifford, and I work with their excellent climate and environmental team, looking at how physical risk is affecting their investees, right? And so I work with them quite closely on how incorporating different types of physical risks into their investing decisions. And I'll give you one very concrete example. Recently, we've actually had a partnership with Exeter University, and they have quite a few climate scientists, prominent climate scientists that we've been working with to map out the supply chain network of one of our investees. Essentially, they bring so much unique perspective on not only whether one facility is going to be underwater in the next 10, 20 years, but much more about the socioeconomic aspects that will occur to the labor force, for example, nearby, right? And to the demand of the goods that are affected by climate change. And so we were actually able to use this information that they produced, engage with their investee, and what they said to us when we were engaging with them was that their builders, their manufacturers, they understand that their facility is vulnerable, but these other aspects about thinking about what will happen to corn production or wheat production in the area that will support their labor force is something that they hadn't thought of, right? So in these ways, we can really work with not only climate scientists but economists to bring out real numbers that are actionable to produce results and engage with firms and companies.
That's such a great example of why this collaboration is actually so important. A question to both of you, but I'm going to start with you, Tom, is did anything from your findings surprise you?
Yeah, definitely. I mean, the thing that surprised me was that sustainable and traditional funds are not that different. I mean, I expected them to be sort of chalk and cheese, but actually there are very, very large areas of overlap between the two, and really great similarities in the attitudes of the portfolio managers and actually how they in practice behave. So that for me was probably the biggest surprise.
Atreya, how about you?
Sure. What surprised me was this huge difference in what climate scientists and population estimates were back in 2010s and what they how they actually played out. And I was so surprised by this, but that I reached out to the ones that developed these forecasts, and they were also surprised that they were so wrong. So that was quite a surprising step that we both kind of understood. But the science is changing. It's changed especially in the last 4 or 5 years. The models have been updated. So I haven't looked at the newest years whether they've incorporated this new type of risk, but I'm guessing the market has thought about this and incorporated this type of population shift.
Well, you've just answered the next question really nicely about how your research findings challenged prior literature. Tom, did your findings also challenge prior literature?
Yeah, I mean, I think one of the areas, I think, for new research that comes out of our literature is that a lot of the academic modeling of sustainable investing takes the view that you've got an investor who has dual objectives. They have some financial objectives and they have some non-financial objectives, and they kind of weight those or trade them off in various ways. And that's a kind of the classical model of an asset owner. What our research sort of really emphasizes is that that's fine, but the asset owner is often implementing that strategy through delegating to an asset manager. And that asset manager has a very different set of motivations. They're not necessarily sharing that kind of combined utility function, if you like, with the asset owner. So I think there's a real call for research around, to what extent is it possible for an asset owner who has this sort of combined set of objectives to implement that through a model where they're delegating to fund managers who are fundamentally financially oriented, subject to some fixed constraints. And there are potentially some quite big inefficiencies there, or gaps that are created, or actually it may be that there's a pretty good approximation that you can get. But at the moment, we haven't really modeled that market structure.
Fantastic. Thank you for highlighting, obviously, some future challenges to maybe deal with here. Got time for one last question. We have one for you, Atreya, specifically. Do you think local insurance markets have a role to play in improving resilience against this type of risk?
Sure. Yeah, I think this is so. My paper traditionally looks at markets other than the U.S. Right? In the U.S., it's very different because insurance uptake locally is so high in comparison to other countries around the world. Right? So there's insurance markets around the world are very little. I mean, Europe it's a bit more, but if we see more development of insurance markets, potentially there could be more resilience as well in these communities, in these regions that are affected. So I'm hoping there's going to be more development in that area. But hopefully, the new hurricanes that are coming out in Florida and whatnot, these are underinsured areas. So it'll be interesting to see what the outcomes are when these hurricanes do hit. Yeah.
Fantastic. Well, listen, I mean, we've got more questions and we could talk to you for much longer, but we've got to go because we've got some great plenary sessions coming up. So, Atreya, Tom, congratulations again, and thank you so much for making time for us in the studio.
Thank you.
As I just mentioned there, we're going very shortly to the plenary for our first keynote from Canadian Deputy Prime Minister and Minister of Finance, Chrystia Freeland. So stay tuned for that. This will be followed shortly by a second keynote from Mark Carney. And then that will be followed by a debate on where should net zero investors be putting their focus to keep 1.5 alive. Some of those speakers will then come straight to the studio to continue the conversation here, and we can pose your questions to them. So you can do that using Slido. Just make sure to select Live Studio when you submit your questions. So stay tuned and we will see you back here shortly.